Good afternoon, everyone, and welcome to our webcast. I am Ioanna Stylianidou, a Director of Transfer Pricing Services, and I have here with me Eftichios Eftichiou, a Partner of Tax Reporting and Strategy Services, and we will be the presenters of this webcast. Please use the box on your screen to submit questions as you listen to the webcast, and you can also send us your questions by email, either to us or your usual PwC contact, and we will reply after the webcast. We expect that this webcast will have a duration of approximately half an hour. Now, let's look at our agenda. Eftichios will make a brief introduction, and then we will provide an overview of the new tax circular and the requirements introduced. We will then discuss the impact of the circular on Cyprus financing companies and make some suggestions about the way forward. So, over to you, Eftichios, for the introduction.
Thank you, Ioanna. Hello, everyone. Cyprus has started to introduce new tax measures and obligations in line with global tax developments in the post-BEPS era. The BEPS project has placed the increased focus on transfer pricing and transparency, and on the allocation of profits between jurisdictions, supported by wider exchange of information between tax authorities. In Cyprus, country-by-country reporting, in line with BEPS Action 13, has been introduced already. Even though the Cyprus tax legislation includes provisions requiring that related party transactions should be carried out on an arm's length basis, this new circular provides guidance on the practical application of the arm's length principle on financing transactions. The circular has been discussed extensively with the European Commission, and in fact, Commissioner Vestager, who is in charge of competition policy, has welcomed the issuance of the new circular, which, as she said, addresses the Commission's concerns that, quote, some tax rulings for financing companies endorse very low margins and a low taxable base, unquote. Further developments are expected in Cyprus in the transfer pricing area, with the introduction of specific transfer pricing rules and documentation requirements in line with OECD guidance. The Cyprus Government Tax Department is also focusing more on and is questioning arm's length issues in tax examinations. We expect that we will also experience more extensive and frequent interaction between tax authorities in different jurisdictions. So the post-BEPS era is expected to increase tax controversy and will necessitate the resolution of disputes with tax authorities for cross-border transactions. That's all as an introduction. Ioanna will now provide an overview of the new circular and its impact, and we will have some simple mathematical examples later on.
Thank you, Eftichios. Indeed, many developments in transfer pricing are expected, and businesses need to start preparing for them. They need to start taking the necessary compliance steps, but more importantly, they need to identify and, to the extent possible, mitigate any risks arising for them. These developments also impact the way activities are structured in terms of functions and allocation of risks and capital, and the key point to remember is that in this new environment, actual conduct prevails contractual arrangements, and therefore the allocation of profits to the various jurisdictions in which a group operates will need to follow such actual conduct. So how you actually execute the transactions is more important than how you describe them in contracts. Now, let's talk about the new circular. Cyprus has moved away from the simple application of fixed margins for back-to-back financing between related parties. If you remember, these were dependent only on the value of the transaction and were subject to some conditions. The new circular, effective from the 1st of July, broadly requires that the arm's length margin arising from intra-group financing transactions needs to be derived on the basis of an economic analysis, and it needs to be substantiated in a transfer pricing study, which is prepared in line with OECD transfer pricing guidelines. So from a transfer pricing perspective, the arm's length remuneration is generally determined on the basis of the prices that would have been agreed in the open market for comparable transactions concluded between independent parties. So the OECD transfer pricing guidelines require that in order to determine the arm's length remuneration, the transaction needs to be analyzed in detail so as to help you identify comparable transactions that are carried out in the open market. And the new circular introduces exactly this requirement for financing transactions. So now there is a need for a more detailed analysis of intra-group financing transactions in order to determine the minimum amount of profit to be taxed in Cyprus. I will just briefly mention here that an optional simplification measure has been introduced. This applies for pure intermediaries. That's for entities that pursue a purely intra-group intermediary activity, but we will cover this in some more detail later on. Even though in principle the circular follows OECD methodologies and OECD transfer pricing guidance, it is new for Cyprus, and still there are many gray areas which will need to be analyzed in detail. And there is very limited experience on its interpretation, especially from the side of the authorities. So we are in close communication with the authorities in order to clarify ambiguities that we identify and create more certainty on the practical application of the circular for our clients. So now let me guide you through the requirements of the circular in more detail. As I mentioned, the circular is effective as from 1st of July, and it applies for all transactions existing on this date or transactions to be concluded after this date. For the tax year 2017, the predetermined fixed margin rules will need to be applied for the first 6 months, and the circular must be applied for the second 6 months. Any tax rulings previously obtained in relation to the application of the fixed margins for specific transactions will apply only up to the 30th of June, and they will no longer apply after the 1st of July. New rulings can be obtained or requested from the authorities, either for existing transactions or for new transactions, but this will need to be based on the methodology prescribed in the circular, and they will need to be supported by an appropriate transfer pricing study. Now, transactions under the scope of the circular. The circular applies for Cyprus corporate taxpayers that engage in intra-group financing activities. I refer to them as Cyprus FinCos in this webcast. So Cyprus FinCos engage in intra-group financing activities, that is the granting of loans or cash advances to related parties, and these loans or cash advances must be or should be remunerated by interest. And this activity can be financed by financial means and instruments, as is mentioned in the circular. For example, debentures, private loans, cash advances, or bank loans. And this can be obtained from either related or unrelated parties. What is not covered is the provision of financing to third parties and financing activities that themselves are financed out of equity. For these types of transactions, even though they are outside the scope of the circular, the general arm's length provisions of Article 33 of the income tax laws would still apply. Now, going back to the transactions covered by the circular, I would like to point out that there is no detailed definition of what falls under loans or cash advances, and in practice, financing may take a variety of forms. So it's important to consider each transaction on the basis of its specific characteristics. One final point I would like to make on this slide is that there is no de minimis rule or threshold for transactions under scope. So the circular applies for all sizes of financing in terms of value or volume. Now, let's see how to determine the arm's length remuneration for transactions under the scope of the circular. It is necessary to determine whether the agreed remuneration for this intra-group transaction corresponds to the price that would have been agreed in the open market by independent parties in comparable circumstances. And in order to identify these arm's length remuneration, you need to carry out an appropriate comparability analysis. So firstly, the transaction, the intra-group transaction needs to be analyzed in detail or delineated, which is the word mentioned in the OECD transfer pricing guidelines. This means you need to identify clearly and accurately all the characteristics of the transaction, the role of the parties involved, and all the economically relevant conditions that affect the transaction. And this delineation of the transaction will reveal whether the Cyprus PINCO is indeed engaged in financing activities or whether the transaction is possibly of a different nature. For example, there may be merely a provision of services or an agency relationship. Once you have delineated the transaction, you compare its characteristics with those of comparable transactions in the open market so that you can identify the arm's length remuneration. So in simple terms, you need to understand the nature of the related party transaction so that you can then identify comparable transactions actually carried out between independent parties. And then you look at the remuneration which was agreed between the independent parties. You may need to make some adjustments if you cannot find the exact comparables, for example, and basically that's how you determine your arm's length remuneration. The circular analyzes in detail how to carry out this analysis, and it gives indications of what aspects need to be examined in the case of financing transactions. Now, in order to accurately delineate the financing transaction, we must consider many aspects. This is all prescribed and described in detail in the circular. We need to carry out a functional analysis. This means look at the group structure, the role of each entity participating in the transaction, their legal rights and obligations. We need to understand the contribution of each entity to the creation of value within the group, and that's in a broader sense. And we also need to look at specific functions performed by the entities and decision-making in terms of originating and financing the transaction, and also managing the transaction. For example, as mentioned in the circular, consider who is providing financing to whom, what is the commercial purpose of the funding, what are the economic strategies of the parties involved. Consider who originates the transactions, who identifies the borrowers, assesses the risks, designs the terms, negotiates the loans, and so on. And then who manages and monitors the transactions and decides on corrective actions if these need to be taken. A key point to note here is for this analysis, actual conduct prevails, and it prevails contractual arrangements. In fact, this was one of the key changes resulting from BEPS Actions 8 to 10. A detailed analysis of the risks involved in the transaction must also be carried out. In the case of financing transaction, risk plays a major role. On the open market, higher risk induces higher remuneration, so the level of risk actually assumed by the Cyprus financing company will be an important factor in determining whether it earns an arm's length remuneration. So risk analysis is of paramount importance, and this is again in line with BEPS Actions 8 to 10, because the return or the profit, let's say, from the transaction needs to be allocated to the party that controls the risk and has the financial capacity to assume it. And the large section of the circular provides detailed guidance on the application of risk analysis and looking at whether the company has adequate substance and decision-making power to enter into risk-bearing financing, and also whether the company has the financial capacity or sufficient capital, as we will call it, to take on or mitigate the risks and absorb the losses if the risks materialize. We should mention here that the circular provides that if you cannot observe the delineated transaction in the open market and also there is no commercial rationale for such transaction, then it will need to be disregarded. And this means that it will not be considered as a financing transaction, but as something else. In such case, multiple tax implications may arise both in Cyprus and outside Cyprus, such as questioning of beneficial ownership of incomes, non-entitlement to treaty benefits, disputes with authorities, higher tax burden, and possibly administrative costs. So the actual structuring, setup, and execution of transactions and decision-making is now becoming very, very important. Let's look at risk analysis in more detail now. What exactly is required? In terms of substance, the circular notes that the Cyprus financing company will need to be able to address the risks arising in relation to its financing activity and to actually perform relevant decision-making. So outsourcing of daily activities is allowed, and this means that there is no requirement to have all functions performed in-house, but the Cyprus financing company needs to have the ability and the capability to perform the decision-making, for example, to determine the objectives of the outsourced activities, to monitor outsourcing, to review the work of service providers, and so on. The circular also links control of risk with the management and control of the Cyprus financing company, which in any case underpins its Cyprus tax residence status. And it lists certain criteria to demonstrate actual presence and management and control in Cyprus. For example, having Cyprus tax resident directors, holding board meetings in Cyprus, taking management and commercial decisions in Cyprus, and so on. Now, in terms of financial capacity, as mentioned before, the Cyprus financing company needs to have sufficient capital to take on the risks and absorb the loss if they materialize. In actual fact, it means that it needs to demonstrate that it is solvent. In the case of regulated financing institutions that are subject to prudential requirements, these institutions need to have sufficient equity levels so as to comply with the specified solvency criteria as per the various EU regulations. So the circular provides that if the Cyprus financing company has a profile which is comparable to a regulated institution, and its equity level meets the specified regulated solvency criteria, then it will be deemed that its equity level is high enough to absorb the risks if they materialize. But in practice, a small number of Cyprus companies may fall under this category. So for the majority of Cyprus companies, they will basically need to assess themselves, and possibly with the help of transfer pricing professionals, the level of equity that they need to have so as to demonstrate that they are solvent and can absorb risks. In order to calculate the required level of equity, you need to firstly assess the risks associated with the financing activity. And there are a number of methods and ready-made models that can be used for credit risk analysis and for the calculation of equity at risk. And the Cyprus company will need to select appropriate methods for this and basically calculate these amounts. And we will see how these apply in the examples that we will share with you later on. If the Cyprus financing company does not have adequate capital to control and absorb the risks arising from its financing activity, then it means basically that another entity in the group possibly controls these risks, and therefore the remuneration for such activity should not be allocated to the Cyprus company, but possibly to another entity. Just a small point to note here is that the Cyprus financing company may take risk mitigation steps so as to reduce the level of risk that it undertakes. But these need to be structured and considered in detail, and again we will see how this works in the examples that we are sharing. And taking on no risk would indicate that the Cyprus financing company is not actually engaged in a financing activity, but possibly in the provision of services. And this, as we mentioned, may have other implications. So risk mitigation may be used to reduce the tax burden in Cyprus, but it needs to be considered very carefully. Now, once the transaction has been accurately delineated and we have carried out our functional and risk analysis, what needs to be done is go out and find comparable transactions in the open market. And this process may involve the search through available sources of information, such as databases or other, that are available at the time of undertaking the specific transaction. This process needs to be transparent, systematic, and verifiable, and it will need to be documented in a transfer pricing study. The circular provides a safe harbor rule for those Cyprus companies that have a profile which is comparable to the regulated financing institutions. For these entities, a return on equity of 10% after tax is deemed to reflect arm's length remuneration. And this safe harbor rate will be reviewed and updated by the authorities if they consider it necessary. But the 10% safe harbor rate return may not apply for all Cyprus companies. And it means that companies that do not have a profile comparable to regulated entities will need to carry out a search for comparable transactions on the basis of their own profile and the specific characteristics of the financing transactions that they undertake. Even though the authorities have not provided an indication on what benchmarking approaches or data sources would be acceptable to them, they are happy if OECD-compliant approaches are used, and we can assist you in identifying the most appropriate one for you. Now, to bring it all together, arm's length remuneration is determined by independent parties in the open market. When a transaction is intra-group, you need to delineate it by looking at functions, assets, and risks. And then you search for comparable transactions in the open market and derive the arm's length remuneration. The Cyprus financing companies will need to carry out the analysis prescribed in the circular for each transaction in order to substantiate that their remuneration that they pay tax on complies with the arm's length principle. And this analysis is required to be documented in a transfer pricing study prepared by transfer pricing experts. The circular implies that such a study has to be prepared before entering into a transaction, but there is no specific requirement to submit it to the authorities unless they request it. For example, they can request it during a tax examination or in the case where a ruling is requested. Now, as mentioned before, rulings may be requested to ask the authorities to confirm their agreement to the results of a transfer pricing study. And such rulings, however, will be subject to the exchange of information rules under the EU directive or any other relevant agreement. An important point that is not covered explicitly in the circular is the comparison of the arm's length remuneration as documented in the study with the remuneration actually shown in the books of the company. And we expect that further discussions will be needed in this area, for example, on what elements need to be taken into account. Because of the specific provisions of our tax legislation with respect to deductibility and allocation of expenses and the treatment of foreign exchange differences and so on. Now, before we move on to the example, a final point to note on the simplification measure. This is an optional measure. It applies only for companies that pursue a purely intermediary activity, and for those companies that grant loans or advances to related parties that are financed by intra-group loans or advances. So that it has a narrow scope. Adequate substance must be in place. And the simplification measure provides that in such cases, transactions under the simplification measure will be deemed to comply with the arm's length principle if the entity receives in relation to these transactions a minimum return of 2% after tax on assets. And we will see this in the example later on. The simplification measure will need to be declared on the company's tax return. And a full transfer pricing study is not required, but it may be necessary to document the existence of adequate substance. And the use of the simplification measure will be subject to exchange of information under either the EU directive or possibly other agreements. Now, let's briefly consider the impact of the circular by looking at a few examples, and Eptichios will guide you through these examples.
Right, thank you, Ioanna. Just to try and demonstrate some of the things that Ioanna has been describing, we have 4 quite straightforward mathematical examples. So starting with the first one, and this is a purely hypothetical example. It's based on assumptions, and it's trying to demonstrate the impact of the circular. Of course, we need to stress that each financing transaction will need to be analyzed separately in order to determine the appropriate arm's length remuneration, and the results of this example should be used only for illustration purposes. So in our example then, a Cyprus financing company, we'll call it Cyprus FinCo, has provided a loan of 100 million to a related party. We assume this loan was financed by debt. As per the application of the previous fixed margins rules, the annual taxable income from this transaction would be 250,000, as the 100 million loan falls under the 0.25% band. And the resulting Cyprus tax liability would be approximately 31,000. Let's see the impact of the circular now on this position. As we discussed before, a detailed analysis of the transaction needs first to be carried out. Let's assume we have performed the functional risk analysis, and from this analysis we determine that the company meets the substance conditions and has adequate substance as described in the circular. The credit rating of the borrower is BB+, so just below investment grade. The loan is secured, and therefore risk mitigation has taken place. By using an expected loss model, the expected loss of the loan is 5.57%. This shows how risky the loan is, taking into account the probability of default of the borrower and the percentage of loan that may be non-recoverable. This is calculated using a specific model and by looking at the financial statements of the borrower, the country of the borrower, and other factors. We have calculated the equity at risk so as to confirm that the company can absorb the risks it controls. Equity at risk would be 5.57% of the loan amount, so that is 5.6 million approximately. Now, assuming that the company has adequate capital of 5.6 million, then it can be treated as a limited risk entrepreneur for this transaction. Arm's length remuneration would then be determined on the basis of comparable market transactions. In this example, we have used the capital asset pricing model approach, the CAPM approach, incorporating market returns to determine the arm's length remuneration for this transaction. On this basis, the post-tax return on equity is 4.68%, and therefore the resulting remuneration after tax is approximately 261,000. In this example, therefore, the application of the new circular would lead to a very small increase in the profit subject to tax in Cyprus, and therefore a very small increase in the tax charge, compared with the fixed margin rules approach of the past. Moving on to the second example, If we change the assumptions and the characteristics of the transaction, the results would of course be different. Let's say here that the loan is not secured, and the company therefore undertakes more risk. In this case, by using an expected loss model, the expected loss of the loan becomes 7.66%, i.e. higher than in the previous example. And the equity at risk would be 7.66% of the loan amount, or 7.7 million approximately. Arm's length remuneration, using again the capital asset pricing model approach, would be 410,000 before tax. So in this case, the absence of security on the loan increases risk, therefore the arm's length remuneration, and therefore the tax charge. Moving on to our third example. In this third example, we change the degree of risk back to limited risk, but we change the credit rating of the borrower to a lower rating of single B. In this case, the expected loss of the loan becomes 12.3%, and the equity at risk would be 12.3 million approximately. Arm's length remuneration, using once again the capital asset pricing model approach, would be approximately 1.8 million before tax. So in this case, the higher risk associated with the financing activity because of the lower credit rating increases the arm's length remuneration. As mentioned, these examples are purely hypothetical, and their purpose is to demonstrate how the circular could be applied. The selection of methodologies has been made only for the sake of these examples, and the methodologies will need to be carefully selected on the basis of the specific circumstances. But the general message is that the principles prescribed by the circular do not have the same impact on all transactions, and therefore each transaction needs to be considered separately. And as we mentioned before, the analysis needs to be documented in a transfer pricing study. Now let's look at the final example, and this is for the simplification measure. This can be applied only for purely intermediary financing activities. Substance needs to be in place. For the simplification measure, detailed risk analysis is not required. The expected post-tax remuneration would be 2% on assets, so that's 2 million, or approximately 2.3 million before tax, which is significantly higher than the tax burden on the basis of the fixed margins rules of the past. A final point to mention here is that in the case where the functional and risk profile of the company shows that it is not an entrepreneur with respect to the financing transaction, but merely a service provider, for example, of administrative nature, then the remuneration for the provision of such service may be benchmarked using a cap approach. The results of such benchmarking would depend on the specific characteristics of the case. However, it is possible that the service fee, as percentage of loan value, would be at a similar level as the fixed margins applicable up to 30 June 17. However, in such a case, as we mentioned before, beneficial ownership implications and the exchange of information may be triggered. So that's all the mathematical examples we have. And let's go back to Ioanna now for closing remarks on the way forward.
Thank you, Eftichios. So, to conclude, the key takeaways and the way forward. The new circular broadly requires that an economic analysis based on OECD transfer pricing guidelines is carried out for intra-group financing in order to determine the appropriate arm's length remuneration in Cyprus. And this analysis needs to be documented in a transfer pricing study, so transfer pricing documentations are being introduced. Rulings and opting for the simplification measure that is provided by the circular may trigger exchange of information, and this is important to remember. Non-compliance with the circular may also lead to adjustments to the tax base, and it may also trigger exchange of information. Now, what's the way forward for businesses and what do we suggest? Well, firstly, we suggest that you need to consider the substance requirements and carry out a detailed substance and functions review in order to determine whether any changes are needed. You need to consider the risks that are involved with the financing transactions that are being carried out, and possibly revisit the group's risk mitigation strategy. The detailed functional and risk analysis may indicate the need for a revision of the substance level or even the capital structure of the group, and possibly the way transactions are being carried out and documented. Transfer pricing studies will need to be prepared, and these will broadly include functional and risk analysis, the computation of capital adequacy, and the results of the necessary benchmarking that will be carried out. And these will be needed for either for obtaining rulings or for defense in tax examinations. As we mentioned, if you're considering to opt for the simplification measure or even do nothing and simply not comply with the circular, the wider implications of exchange of information and increased controversy will need to be considered. As a final remark, we note that there are still many gray areas because the circular is very new and transfer pricing in a more detailed and structured format is very new to Cyprus and the Cyprus tax authorities. Even though professionals have been working with transfer pricing matters for a number of years, our authorities are still not very experienced in this area. And this means that many of the issues arising from the practical application of the circular will need to be discussed with them on a case-by-case basis. So we consider that it is very important to start discussions with your tax advisors and determine the impact of the circular on the specific transactions. As we have seen in the examples, the impact depends really on the specific circumstances, and then consider what corrective or actions or compliance steps you may need to take. We have come to the end of our webcast. Thank you all for your attention and for all the questions that you have submitted to us. We will reply to all questions directly, and please feel free to send us, even after the webcast, further questions either to us, here are our contact details, or to your usual PwC contact. Thank you, and have a nice afternoon.
Thank you, everybody.